This week is super important for all of us as traders and investors. Not only do we have the inflation figures coming out for the US, but it's the earnings season kickoff, and there are sure to be fireworks in so many volatile stocks. With Tesla doing exactly as we thought it would and the S&P 500 melting higher, how much more could there be in these positions? Today we discuss that along with what's going on in the cryptoverse and the new opportunities arising. Wall Street has been sneaky and they've been rotating just as we suspected. So let's break down some amazing positions throughout stocks, commodities, and cryptos around the world. It's going to be a good one. Let's get into it. Well, welcome back everyone to the special weekend edition of The Daily Show. My name's Tom. Today we're discussing everything from the macro to the data that we need to know about markets right now. And let's just do a quick recap. It was an excellent week for breakouts, in particular Tesla, which we expected to go all the way to 250, managed to achieve it. And AMD had another nice breakout that we've featured a few times on the show recently. But we've got more coming up in today's show as breakouts seem to be everywhere in stocks that have been running behind. So remember, if you're a new time viewer, subscribe, smash that bell icon. It's great to have you here. But let's get into the first story straight away. And that is discussion about, of course, the bubble or the parabolic move that we are currently in. Many people are concerned about NVDA. And it's one of the polls I took recently of you guys was that you were concerned about buying the dip. And rightfully so when it comes to NVIDIA, as you will see in a few charts here. Are we running a very big parabolic move? Absolutely. And it's now become a GDP percentage, which actually marks 11.7% of the entire enterprise value versus GDP of America. And this absolutely surpasses where we were with Cisco back in the 2000s. Now, does that mean it's instantly, very scary to buy NVIDIA or anything like that? No. It just remember that you always see with every new bubble that it becomes bigger than the last, and they are, of course, the bigger they crash. Now, one of the things that always goes on here is you've got to think about concentration. And as we've talked about in a recent chart, whenever you get concentration of a pair, that is that basically maybe an industry is becoming too large a part of the markets, they either self-adjust quickly and everything plays catch up, or they become so concentrated that when the fall happens, you don't want to be the buyer of the dip. Now, why is that? Well, it can take literally 10 years for some of these stocks to recover back to those peaks, and some just never even get there. So this pretty much demonstrates it, and you can see that there have been many bubbles in time: the energy bubble, the tech bubble, and the financial bubble. And there will be some things that we're looking for when it comes to these particular charts. But let's just say they tend to end brutally, and they tend to end in extreme volatility. And I'm not sure we're at that point just yet. But let's talk about the jobs numbers, because they were another disgrace. And what I mean by that is you can't trust these numbers, guys. Both May and April jobs were now revised down again, as we suspected, 111,000 jobs. May's numbers were adjusted from 272 to 218. And of course, April's were 165 to 108. Now, this marks the 10th downward revision in the last 15 months. And this is really what we've been going on and on and on about when it comes to these numbers. Don't try to trade the numbers. Instead, look for reactions to it in the market and then trade the actual liquidity steals, those types of things. And of course, in this case, it looks kind of like this. As you'll notice here on this particular chart, we are pretty much sitting in around the same levels that we have been for a while. So even with these revisions, overall, yes, okay, we know the market is weakening, but that's what the Fed's main aim is to do right now. They're trying to be restrictive. You can see this game of trades, job openings declining rapidly. Particular chart shows that probably we're going to see a lot more weakness in the overall job openings. But I think it's important whenever you look at these particular charts to put it in perspective. This is firstly coming off a very strong economy into a flash crash, which we know back in 2020. But really the ones we're more interested in are these ones here. And you'll notice they're coming off a lot lower bases. Now, you could argue, well, there's more people in the US, so therefore more jobs. But I would argue that you need to be down quite a lot lower before you even hit a point that looks really worrying. Somewhere between 5,000 and 6,000 might be where you need to hit just to even get back to, let's say, normalization when it comes to these jobs numbers. So on the first case, will we end up being in a recession? Well, I've said for a long time, I do believe so, but I do think that we're still running a late cycle bull narrative. And some of the things that even started to break out last week point us towards still thinking that particular thing, including gold. I thought this was an interesting chart. It's probably going to be very, very difficult to see here on the video, but if you take a snapshot of it, you might be interested. And this is from Jurian Timmer. And what it shows here, I didn't actually ever know this, but the top tax rates back in history were really wild. And in particular, near the end of the 1929 crash, we were getting towards 25% tax on the top tax rate. Then it went into the 60s. Then it went all the way up to 94% over here back in 1940s. And then, of course, it's now at around 37% in the top tax bracket. Now, this is interesting in some ways just because I think that what tends to happen before we really go into epic busts sometimes is we actually get tax cuts. And that seems to be fairly consistent. Back in 2004, 2006, we got a little tax cut there. And of course, there's some tax cuts that came through recently and maybe even more on the horizon. So it's interesting to see those around those recessionary periods. All the good times are going, tax cuts seem to come through as well, and then bad things happen. And I think that's because we push the system and we ask everyone to borrow more. So how do we let you borrow more? Well, you get a little bit of a tax break so we can continue kind of letting the system run its way. Let's have a look at buyers and sellers in US bonds. We're basically trading where you would expect us to. Now, treasuries are doing pretty poorly, but I just want to kind of reiterate this because this was a period where treasuries also did poorly before the global financial crisis, and then they ended up being a doubling kind of thing during that particular scare. Now, do remember, I do suspect that this is the type of thing we're going into in the future, and therefore, while treasuries might not be a stellar kind of trade over the next couple of weeks or months, they probably will be when you look at them in a multi-year approach. Now, another thing that a lot of people are discussing is the S&P 500 days without declines. We've featured these types of charts a few times and we've had a look at it. It doesn't necessarily mean it has to be volatile straight away. But do remember when you enter into the 40 to 50 bracket, you are starting to take out those kind of last outliers generally. So sometime in the next couple of weeks, we would want to be paying attention, in particular after the next 2 weeks, which we know is the longest stretch. Here's another chart from Jason Gopfert over at on X, and basically it says the composite keeps hitting new highs with many stocks falling to new lows. And we've only really seen this during two main periods. We saw it during the 1990s, of course, during the dot-com boom, and we saw it in particular right in the 1960s, which are the two most correlated, as we know, with the current market. So again, a concentrated market, something that means that you need to be careful of index investing as well in the future. And this is because of something they call the lost decade. Sometimes when you wipe off a bubble, it does take a while for an index to catch up. If you've never looked at the Nikkei, I would certainly do that. I would also look at the European markets. And of course, you could also go and check out some of even the Asian markets over certain periods, such as the 90s into the next 10 years, and even actually the US market from the dot-com bubble to the GFC. What tends to happen is you get that lost decade in index investing. And because everyone loves indices right now, I wouldn't be surprised if we go into that next time we do end up in a crash. What do you guys think though? Is it a stock pickers market into the next kind of big pullback? Is it a stock pickers market right now? Let me know in the comments down below. Now, here's another chart from Charlie Bilio, and it says here that basically we are on track for one of the most wild years. And this is currently on track for the third most all-time highs in a year of all time. Now, that's kind of showing you that it's a pretty aggressive market. And we know here that the S&P 500 consensus is pretty aggressive as well. In fact, the consensus is that we will see a return, according to Mike Zaccardi's chart over here, a 17.1% annualized over the next 5 years. Now, that's a pretty wild assumption. And you tend to get wild assumptions. Yes, that's right. Sometimes into big problems. You get wild assumptions, particularly in concentrated markets. And that's where we find ourselves right now. But yeah, 17.1%, that'd be pretty sweet. It sounds like everyone's getting very hyped on where the markets are at. Meanwhile, all of that, we see metals breakouts. And why is this so important? Well, US inflation expectations are actually going through the roof again. And you can see here by this chart from Tavio Costa, you can see inflation expectations are going up and economic surprise indicators are going down. Now, what does this mean? Well, if anyone guessed it, stagflation now becomes a very real thing. And as we know with stagflation, what tends to do well? Commodities and metals. And the market just started putting these back in place over the last week. And we know that there are plenty of different metals that are going to be in demand over the next couple of years. We also know that there are only a few countries that produce really large quantities of certain things, rare earths, nickel, copper, as you can see, dominated by particular countries. And we know that India in particular is becoming a huge superpower when it comes to growth. So things like coal as well, which they use a lot of, are now under a lot of pressure in terms of prices. Now, why is there pressure? Well, we haven't done any exploration for a long time, and it takes a while to get a mine on board. In fact, it takes 15.7 years on average, and it's been a while since most companies invested in these things. So it does make sense for us to be playing potential catch-up. Gold's been doing well this year, and it continues to be one of our favorite particular metals out there. And we also see here that it looks like a lot of other things aren't playing catch-up just quickly enough. GDX in particular, which is gold mining stocks, they're behind gold price. And we just saw a beautiful breakout last week, as we know, and it led into a very nice Friday indeed. Now we go into earnings season as well. So not only do we have inflation, not only do we have metals breakouts, but we also have the big ones coming this week with the kickoff of the banks. How good is the debt system looking? I would say there's some record profits going on in a couple of these banks, and I wouldn't be very surprised at that at all. And of course, price action has been detailing that as well, with some strength coming into many of the banks. Why? Well, I think it's loosening in terms of the overall needs on people. Like, low docs are back. And in Australia, these types of things are starting to appear. Longer loan periods, buy now, pay later, all of these types of things. We need you to get credit even though interest rates are really, really high. It's kind of that two-pronged attack. Yes, we're trying to hurt the economy by having high interest rates, but at the same time, banks are incentivized to lend to us and, of course, give us more liquidity. Now, median 2 weeks, we know that with the strong breakout of the S&P 500 and NASDAQ last week, it tends to lead into this first half of July being strong. We saw that early on. It reversed all that negativity and, of course, pressed forward. And we do know that this is the best 2-week period of the year coming into the earnings season. We also know that around this earnings season, we should start to see volatility come back in. Does that mean we're going to get those 1% or even 2% down days on the S&P? Maybe. And you'll see here the VIX structure certainly increases earlier this year than it usually does. And during the last period, we really saw kind of July start to see VIX increase, but in particular, it started kicking off into August during the 2020 election campaign. And I wouldn't be surprised if we go a little earlier this year, maybe even earlier August, later July, that kind of period. So the question then becomes, should we actually be invested still in markets? And the answer is generally yes, if you believe in this type of chart here, which basically shows you some of the most closely correlated markets to right now. Now, don't worry about 1920 to 1929, the one that everyone obviously correlates. It's not really that important because it went into a hyper bubble very, very quickly. And you can see how fast it was in terms of a cycle. This particular cycle, though, seems to be going on track to get to that 900, maybe even 1,000 days. So therefore, we are seeing a similar period to the 60s and the 2000s. The 2000s concentration, the 60s concentration that also ended up having stagflation afterwards, which I thought was an interesting point. And of course, most of the big Wall Street players, as we saw before, they all expect quite a lot of growth over the next couple of years, and they're all pricing that in. So as long as we can live up to expectations in those concentrated stocks, and I think NVDA probably will, even though it's starting to get downgrades, that is across the board what you're looking for. Can the concentrated leaders continue to run, or will the rest play catch up? And in this case, I believe it's a stock pickers market from the question before, which basically means that we need to be looking at different sectors. And there's already been so many opportunities this year. We had energy earlier, we had metals earlier, we've had semiconductors 2 times this year already run out. We've had utilities do a really great run on them, and of course the banks as well. And there've been some stellar returns. Let's move over here to the Bitcoin discussion. This is just a quick Bitcoin chart here that overall has the 200-day moving average on it. And you can see that's where we ended up hitting into through the trade. Now, this could be the last big stop for Bitcoin because we do know that during most of the halving cycles, if it's going to do well, it needs to start turning around over the next 25 kind of days. Now, can it do it? I'd say yes, it can. And one of the main reasons is because this does seem like a lot of FUD. I posted over on X some of the reasons that Bitcoin's going down, some of the weakest reasons I've seen in a while. And in particular, MT GOX stuff. I wouldn't really worry about that too much. Mostly, it's just, I think, a shakeout. And we're, of course, looking for price action to turn around. But how low will it go first? Well, we'll look at that later on today's chart. Now, let's have a look at the 5-day turnaround. So you'll notice a couple of things that are interesting here. Home builders down pretty hard. That's starting to get concerning. But we do have gold amazingly well, GDX stock. We've got metals, as we suspected, doing well. Semiconductors continuing up, down, and all around. And we also have some of those other sneaky sectors. The American consumer, XLY, thanks to Tesla and Amazon. And of course, the banks as well, running a little bit into their earnings season. And as long as the banks still remain fairly firm, that's going to be a good sign for the bulls in the market, especially during pullbacks. GDX had the best Friday, and you'll notice here across the board, it was a pretty good session, although energy stocks were a bit disappointing through the session. Let's now move over to the S&P 500, a close on the daily high, almost all the way up the peak. That's kind of pointing towards that 5,600 now. And really, it doesn't look like it can be stopped. Although we know that it is in an extreme overbought zone now, we're basically at that extreme point. Just like we said before, whenever we get these particular reads, we usually either see a turn very quickly afterwards, or we get around 2 weeks left of running. And we've had that a few times now where we've had 2 or 3 weeks left of running or extreme moves already hit right around when we tend to get these overbought indicators. And what that's basically telling you is almost everything's overbought across the board. We've had a great run in it. Does that mean I would go and short the market? Absolutely not. And I'll explain why. We are in a positive gamma situation from the options market perspective, and there is no weakness. Is there a series of higher highs and higher lows? Absolutely. Like we said last week, one of the things that was really most important with the bears were going to take control, they were going to close underneath 54.50, 54.40. Now, if they'd done that, everything changes. I believe flow would turn negative gamma. It would go down. We'd lose 100 points pretty quickly. But that's not what happened. It found buys all the way through there, did this candle, and from that point, you had to turn incredibly bullish. That's what trading is. It's having the patience to react to the money flow, to react to the equilibrium move into the next level. So in this case, it's still more bullishness for now. There's no signs of impending weakness straight away there, other than some cautionary tales, and we'll be looking for the price action. 55.32 could be a little bit of temporary intraday support, not only being the one-day options move, but also a little bit of structure underneath the hood. And call resistance for the Monday trade based on 0 DTEs is sitting at 55.75. So that might be worth watching as well on the top end. But really, the market could be, I think, expecting to move through towards 5,600, at least at this point. Let's move over to the positive gamma side. You'll see a lot of calls sitting on the Monday trade all around that 55.65, 55.50, and 55.75. As the market, if it does move through those levels, of course, dealers may be offside and they may have to hedge, which of course could push that 5,600 narrative. And you'll notice that the next day, the market moves towards 5,600. And that again pushes that idea that there's probably more bullishness than bearishness in this market right now. When it comes to the July overall OPEX, that's moved to 5,600 now. And again, this is your key resistance at this point. So every 100 points usually looks like this, but that's the way it's playing. What about CTAs? Well, they've been buying a little bit in the NASDAQ. They've been kind of stagnant in the S&P. So again, the momentum style funds, they are moving towards in and going in. And as we suspected with copper, we saw that flick on CTAs. We saw the flick on price, and they are stacking. They are going wild. So copper has been an amazing couple of positions here the last few days of trade. And you can see why the CTAs went wild on it. CTAs also went wild on gold, buying up big time and getting back into that. And they became a little bit less buy on Brent. But still, I think overall, this is a positive chart. But yeah, they certainly moved straight into those metals again. Now, 250, 245 is going to be the important point for Tesla this week. And we already know this is where our key resistance is. So while the charts are super bullish coming into it, I wouldn't be surprised if you're someone sitting there with huge amounts of profit. We started liking that stock quite a while ago, back in the 170s. So, if that particular, position is looking pretty good, this is a point where you've got to make a tough decision. Do you want to scale back your position? Do you want to take it all off the table? Some people say you don't go break taking a profit. I say you don't go broke taking a profit at the right levels. This is certainly a key level. And 250, if it is broken through and closed above, well, that could create that huge positive gamma event and, of course, push the 270, 280 narrative we'll look at soon. NVDA, on the other hand, 130 is pretty heavy for it, as we know, and we expect the stock at this stage to remain between 130 and 115 with basically chopping each way. And that comes off what we've talked about for a while now, which is basically a stabilization of the semis as other markets play catch up. Central bank liquidity, whether it's the Fed or the central banks of the world, they've been a little bit more accommodative in recent weeks. So that's to be noted, of course, on the charts. And when we move over here now to yields, continue to watch the US 2 versus 10. We're obviously looking for uninverted yield curve there. And one thing I found interesting was that yield dropped underneath 4.7 after the non-farm payroll results. Now, this is basically on the expectation that, there's weaker numbers and therefore we're going to get a rate cut. But as we've already said, 10 of the last 15 months have been revised down. So I think it's a narrative. It's nothing new. If it is the reasoning why we go down, sure. But just remember, this has been said so many times. So it's not like, that's now you get edge off the non-farm payrolls result. You certainly don't. It's just funny to see it there. So anyway, underneath 4.7 is a breakdown. That's pointing 4.5 or even 4.45. So something to pay attention to in yields. And you'll notice here, of course, the 10-year also went down. What about home builders? Well, that's looking kind of sick. Now, you'll notice I talk about home builders a lot, and that's certainly a market that I am paying attention to. This is more of a macro perspective, though, and it's starting to show me again signs of, if this keeps going weak now for months and months and months into the end of the year, I would be very concerned about the overall health of the market. So, of course, that's something we're looking at from the top-down perspective. We'll cover it more in the future. Let's have a look at the US dollar. Well, it fell off big time. Yields down usually means dollar down. And it just kept getting hit and hit and hit and hit throughout the week. And basically, this has helped the gold trade, the copper trade, and all of those others. Pretty bad weekly close. It's not underneath, of course, the 1.3, pretty much somewhere around 1.37, 1037 that we'll be looking at in the future. And if it gets underneath that, then we're probably seeing our doubling top in the US dollar. But at this point, I would say it's weak. It still theoretically could be bought somewhere around this doji here, which is 104.26. And I would expect, if I was looking at it this week, something like this to possibly occur. And if it did go underneath here, then of course, for it to drop substantially, that's going to be where the real trade comes in for the US dollar. But it is looking much worse than it did last week. Now let's move over to copper. Does that look a lot better? Absolutely. That is a lot better than it was. So copper had some strong sessions in it. We suspected this. Soon as we cleared that 20, that was a great sign. And then we just kind of powerhoused up to this first key resistance. So I could see us like weakening here a little bit, then strengthening up. I do think that it's a decent chance that we've lowered off on copper now. And we've been looking for this for ages. We knew it was toppy over here. We knew that this was the turn. And this is what you do. You build the confidence in the systems. You build the confidence in the price action. And you can tell probably based on our last video, we went, wow, look at that. That was a lot better than we anticipated because, of course, once you see that change, boom, you've got to be quick. And these markets are quick. Let's move over to gold. Very strong move by gold, closing almost on its weekly high. And you can see here the daily again got through that most traded zone. As soon as that happened on the smaller time frames, it was a go signal. And it ended up putting on some pretty nice money. So, yeah, very nice. If anyone's in these positions, they'd be happy. There were a lot of opportunity. That's 2.33%, basically $50 of the ounce. So not too bad at all. And I would say that we are going to now hopefully come out of this consolidation range. So this could mean our new all-time highs are coming for gold. And it's certainly the first positive sign we've seen in some time. Now, as always, you have to expect, pullbacks and things to occur to freak you out a little bit. But I think this is a very good first positive sign. And it's not just there, it's in all metals. As we mentioned, we saw it in iron ore, we saw it in nickel, we saw it in gold, we saw it in silver, we saw it in copper. We even saw it in yields to a degree in the US dollar. And that is what it's about. It's about building that case scenario. We had it before it even went ballistic. And that's what Stanley Druckenmiller often says. You've got to be a pig. It's something I teach in my courses, particularly my advanced masterclass and my day trading masterclass. It's all about finding the positions, guys, and doing it in a replicable way. And I can tell you that all of those positions were replicable. And that's very important because if you can do that, it's like Tesla, that's a replicable position. If you have replicable positions, then at least you can start to play your stats and you can do it in a methodical way. If you're just going and chasing GameStops and saying, wow, I think it's going up, well, you're just lying to yourself. You know what I mean? Like, it's just gambling. You're going to eventually lose. You could make $10 million really quickly. But if you don't realize that you did it luckboxing, you're probably going to give it up. And I've seen many people, unfortunately, do that. Let's move over to GDX. And you can see here that gold stock was breaking through again. We get a close above. Pretty clear trade on Friday. Looks like it might even break to a new all high. And of course, gold stock is super behind many of the other gold positions. Let's move over to US oil. So not the best daily close. Certainly a decent weekly. Hit our first resistance at 84 a barrel last week. And I'm looking for it to break out and above. So for now, it still remains bullish. But certainly the metals are where the money flow instantly went. And I could see some consolidation here and then ideally a breakout above. We'll be watching oil closely. Tesla, congratulations to you guys. I saw you out there doing real well. So 250, beautiful closure for the week, right into our heavy resistance. Can it keep going? Of course, Tesla's wild. This is a level I was looking for a while. So I loved it. I loved how beautiful it went there. I kind of even loved the fact that Pelosi sold it early and didn't get this money run. I hope all of you guys got it instead. You get Pelosi's money, not somebody else gets Pelosi's money. So, I want you to get it. That's the main thing. So Tesla over here, you can see 250. Yeah, it's a beautiful hit. I mean, of course, your next levels are 275 and then the magical 300. And the upgrades are coming in for this stock. People are getting hyped on it. I think it could be like a buy the rumor, sell the fact, frankly, when it comes to earnings, which is just around the corner. But 250 is, I would have to expect some type of consolidation. And we'll see how the price action worked because basically on the Friday, it doesn't show signs of slowing down. I mean, yeah, it could be some kind of hanging man, but realistically, that's still a very strong candle. So still strong stuff coming out of Tesla. Let's move over to AMD. Beautiful. Another great breakout during the session. Really strong day. Ended up 4.88%. AMD looks like it wants to go as well. Another one catching up to some of the other pairs. Next stop 180, possibly even the 200s for a stock like this. Not bad setup last week. I quite like it. Call it like a 6 out of 10. Could be better, of course, but yeah, we talked about it and it had a stellar session. Now we go over to semiconductor SPY. I still think these are probably sideways market positions, guys. And the way I think we all look at it together is that, semiconductors had a great run. They consolidate, and you know what they usually do? They come back to the weekly mean reversion. Now, they haven't done it yet, of course, but I would say that we're going into a period of under appreciation of semis, and then they'll do better later on. Same thing with NVDA. 130, a little bit too much for it, and it fell off a bit. Got a downgrade, I think, as well from somebody. Let's move over to Intel. Now, this is a position that's interesting. Starting to get a little bit heated here for a relatively crap stock that's done very poorly for a while. So certainly NVIDIA on the watch list. This thing's pretty much broken on some of the small lame low metrics. And yeah, I mean, I've been waiting for it for ages. Members of our markets Masters Club, you guys would know I've been watching this thing and positioning into it for a little bit. So it'd be interesting to see how it ends up going. Very nice breakout, of course. Would like to see some strength coming through this one Monday, Tuesday, this coming week. Let's see if we can get it done. Let's move over to an international market. China, 700, 10 cent. A little bit red here for 2 sessions, but still overall nice bullishness for the week last week. HSI, disappointing again, rejected the weekly. Daily did close above, but as we know, that didn't really matter, above the 20, and we're still above the high. So maybe we're coming to the 61.8. This market all around at the moment, no real swing breakouts. Of course, it's all been very small time frame stuff. I'd like to see it find some buyers. Let's move over now to the Qs. Now, these things are strong. As we know, they've got the same overbought metrics that we have on the S&P. And this is basically, again, telling you that most indicators are showing extreme moves for the current leg rally. And when you get these types of signs, again, could be weakness just around the corner. Sometimes it keeps going up. Here's one here. But because it's synergized with the S&P, I think that, yeah, there's a good chance that we're going to find a bit of strength. We're going to keep melting up. We'll maybe hit some key levels. And then, of course, we're looking for the possibility of a pullback into an election year. Let's move over to the Bitcoin position. And, of course, 58K and a half, that's the key level. This was where the support was. The buyers came in. They got absolutely trounced. I put a poll over on X, and a lot of you guys thought this level was probably going to get hit. Typical of Bitcoin, comes down to 53 and a bit, finds a buyer, and now it finds what we call roll reversal. So will it go back down again and wipe the low? Ooh, it hasn't done enough to go, wow, I want to buy that thing just yet. But the problem with Bitcoin is you're never going to get the low unless you're just a BTD, or you've got perfect leveling. So you've either got to be very, very careful here and say, okay, we're looking towards, maybe buying a little bit and scaling in, or you've really got to pay attention and say, well, I need it above structure. So I need it above 64K before I'm really interested in this position again to go to long, at least with the current information. What I'd like it to do is kind of do this and then that, and I would be very, very bullish. If that happens, thumbs up from me for Bitcoin. But at this stage, still paying attention. Now, Ethereum, on the other hand, actually took the low. That was actually not a bad day trade at all off that level. And it didn't find it, absolutely ripped most traded zone number 2, most watch reaction here level, the first one, it got barely any reaction. But this one got some super reaction. If you actually scroll down and you have a look at the small time frames, you'll notice you did get the opportunity. See these wicks? That's the type of thing you're looking for. Now, that was a great day trade. I'd probably be very careful around it here, just like the others. There's a reason I had watch reaction here. This is exactly where you would expect it to find reversal selling if it's going to. And the trend is still down on some of the major timeframes. Let's move over to what's happening this week. We've got Fed Chair testifying. Then we got him doing that again on Wednesday. And then, of course, we have the big one, core CPI. The inflation numbers are coming out. They're expected to be relatively cool and get us down to 3.1% year on year. Will they do it, though? A lot of the rest of the world has actually gone up. So that'll be a big one. And then PPI on Friday as well, along with the banks coming out with, no doubt, the fact that they've done some great debt writing. And that would be probably what I would expect from this week. Guys, inflation figures, make sure to subscribe, make sure to follow along on the channel if you enjoyed today's video. And of course, if you're interested in finding out more about replication stuff, you can check out our courses over on fxevolution.com or follow us over on X as well. We post plenty of charts over the week. Thanks so much. Have a great weekend. Let's get ready for this week ahead because it's going to be a lot of fun.